Welcome to the Deep Dive, where we cut through the noise to give you the essential insights. Today, we're digging into RH, the luxury home goods brand, after their Q2 fiscal 2025 earnings call on September 11th. We've gone through the numbers, the commentary, everything to figure out what's really going on. And, you probably saw the market reaction, pretty immediate.
Yeah, a bit cautious, you could say.
Definitely. Stock dipped almost 5% the day after, and trading volume shot up, like over 3 times the average.
That usually signals investors are wrestling with something, right? Some underlying tension.
Exactly, and that's what we want to unpack today.
Right, because while the market focused on those initial numbers, the call itself painted this really interesting picture. You got strong demand for their stuff, but then these significant external headwinds.
Mostly trade policy, it seems.
Primarily, yeah. So our goal here is to figure out what drove that market reaction, what RH is actually doing strategically, and, what it means for their big long-term plans.
Okay, let's start with the basics, the Q2 numbers. Non-GAAP EPS came in at $2.93.
Which was below what the street expected. They were looking for around $3.21 to $3.22.
And revenue, also a slight miss. $899.2 million reported versus estimates closer to $904 million.
So slight misses on the top and bottom lines there.
But it wasn't all negative, right? Revenue is actually up year over year.
Yeah, 8.4% increase year over year. And maybe more importantly, management really hammered home the demand growth.
Which right?
A pretty robust 13.7% year over year. So even if sales didn't quite hit the estimates, people clearly still want RH products. There's interest there.
Okay, so demand is strong, but revenue and EPS missed. What about profitability?
Well, that's where it gets a bit more complex.
Yeah.
GAAP diluted EPS, so the standard accounting measure, actually jumped quite a bit.
How much?
Up to $2.62 from $1.45 the year before. Big increase.
Interesting. And margins?
Adjusted operating margin hit 15.1%. Adjusted EBITDA margin reached 20.6%, both up significantly, 340 basis points year over year.
That's 3.4 percentage points. Pretty impressive.
It is, especially because they mentioned a drag from their international investments. And they still managed to generate $81 million in free cash flow.
So the takeaway is maybe top-line challenges, but the underlying profitability engine is still quite strong.
That seems to be the story, yeah. Resilience despite the headwinds.
Okay, let's dive into those headwinds. Tariffs seem to be the big one on the call.
Absolutely dominated the conversation. Management's bracing for about $30 million in extra tariff costs just in the second half of this fiscal year.
Oof, even after trying to mitigate them.
Exactly. Net of mitigation efforts. That's a real hit to the bottom line.
So how do they fight that? What's the plan?
Well, this is where it gets interesting. They're making a really aggressive pivot.
In terms of sourcing?
Yeah, shifting rapidly away from China and India. They expect receipts from China to fall from 16% in Q1 to just 2% by Q4. That's a fast.
Wow, okay. That's not just tweaking. That's a fundamental shift.
It is. And they're also reacting to these new 50% tariffs on some goods from India, mainly hand-knotted rugs, affects about 7% of their business. They're looking for other countries.
It sounds like a massive operational undertaking.
For sure. It shows they're willing to invest heavily in just being more agile, more resilient to these kinds of geopolitical shocks.
And part of that involves bringing production back home, right, to the U.S.
That's a key part of it. They expect 52% of their upholstered furniture to be made in the U.S., primarily North Carolina, by the end of fiscal 2025.
And potentially more in 2026.
Right, which, raises questions about costs, but also about long-term stability and control over their supply chain.
It also connects to what the CEO is saying about the broader industry, doesn't it?
Absolutely. He voiced some pretty strong concerns, warned about significant inflation kicking off in 2025, getting worse in 2026.
Because of tariffs.
He argued these added furniture tariffs could cause major disruption, even job losses. Basically saying a narrow focus on tariffs could backfire on the U.S. economy.
So given all this uncertainty, this tariff impact, they adjusted their outlook for the full year.
They did. Pulled it downwards. Revenue growth now projected at 9-11%, down from 10-13% before.
And margins followed.
Yep. Similar reductions to adjusted operating margin and adjusted EBITDA margin guidance. It just reflects a more cautious stance for the rest of the year.
These aren't tiny tweaks either.
No, they're material. And they quantified some of the impact. They estimate a 200 basis point hit to operating margin just from the international expansion investments.
Okay.
Plus another 90 basis point impact from the net effect of tariffs and mitigation. So you can see these external factors are really biting into their projections.
And this uncertainty is also causing delays in product launches.
Right. A major new brand extension they had planned for the second half of 25, that's now pushed to spring 2026.
And the source book, too.
Yeah, the fall interior source book got delayed 8 weeks.
Yeah.
That shifts about $40 million in revenue out of Q3, spreading it into Q4 and even Q1 of next year.
So pragmatic caution seems to be the name of the game right now. Don't rush things in a tough environment.
Exactly. Better to get the launch right.
Okay, so tactical delays, revised guidance, but then there's this huge focus on international growth. How does that square?
It's a bit of a paradox, isn't it? But it really speaks to their long-term conviction.
They're still aiming to double the company's size in 5-7 years.
That's the plan. And they believe the global opportunity justifies pushing through these near-term headwinds.
Are we seeing any proof that this international bet is paying off yet?
Well, RH England, their first big international gallery, seems to be doing well. Gallery demand up 76%, online orders up 34% in Q2.
That's pretty strong.
It suggests the model can work, that the brand resonates globally, even, outside the big U.S. markets.
And then there's Paris, just opened.
September 5th, yeah. And they're calling it their most innovative and immersive brand experience yet.
I heard some descriptions. Soaring atrium, rare books, even a bronze chariot.
Yeah, they're really leaning into that experiential element. Masters like Vitruvius, Leonardo da Vinci books. It's not just a store.
But does that work? Does it translate to sales in the luxury space?
Well, the argument is that it does. It embeds the brand in a lifestyle, makes it aspirational, builds a moat against competitors. It turns shopping into an event.
And the early signs from Paris.
Really impressive, actually.
Yeah.
Traffic has apparently beaten RH New York, their highest volume gallery, every single day since it opened.
Wow.
And the design pipeline, the projects lined up in just the first 6 days. More than the first 5 European galleries combined generated initially.
Okay, that is significant brand heat. Seems like validation.
Definitely feels like it. And they're not stopping. London and Milan flagships are planned by spring 2026.
Building this global design ecosystem, as they call it.
Right. Blurring lines between home, retail, hospitality. It's a multi-billion-dollar vision, way beyond just selling sofas.
It's about curating a whole lifestyle.
Exactly. Capturing more share of wallet, building loyalty across different parts of a customer's life.
Now, the CEO also spent some time talking about the housing market context.
Yeah, framing their performance against what he called the worst housing market in almost 50 years, running for 3 years straight now.
He had that stark comparison, right? 2024 versus 1978.
Yeah, 4.06 million existing homes sold this year with 340 million people in the U.S. versus 4.09 million sold back in 78 when there were only 223 million people.
Puts the current slowdown in sharp relief.
Absolutely. But despite that, RH claims they're performing like it's a robust housing market.
How do they explain that resilience?
They point to those long-term investments, elevating the platform, the products, the design services, the hospitality. They believe that's what creates separation, allows them to outperform the market.
Interesting. Makes you wonder about the rest of the sector. Okay, so shifting gears, slightly capital management. How are they handling their cash and assets with all this going on?
Well, one key thing is inventory. They plan to convert $300 million of excess inventory at cost into cash over the next year, year and a half, just optimizing what they carry.
That frees up a good chunk of capital.
It does. And then there's the real estate. They hold quite a bit of value there.
How much are we talking?
Estimated equity value around $500 million. Properties like Aspen, RH England, Detroit, Madrid. That Madrid one is actually on the market now.
So are they planning to sell these off quickly?
Management described it more as opportunistic, not a necessity, especially if free cash flow improves. But, if interest rates fall and property valuations look good, they might pull the trigger on some sales or sale leasebacks, unlock that value.
Got it. And what about spending? Capital expenditures?
That's a key point for investors. Adjusted CapEx is projected to drop significantly in 2026 and 2027.
Signaling an end to the heavy investment phase.
Seems like it. Suggests they're moving past the peak spending on galleries and infrastructure, potentially leading to much stronger free cash flow down the line.
The CEO had that Buffett quote, too, about betting on themselves with share buybacks.
Yeah, the Watchtub bet on ourselves. Buying back 60% of shares post-2016, another 30% during the recent housing downturn. Shows real conviction in their own stock, even when things look tough.
It signals confidence, definitely. Now, what about promotions? Luxury brands are sometimes hesitant to discount. How did RH address that?
He tackled it directly, pointed out that in the high-end furniture world, designers and architects routinely get big discounts, like 30–40% off.
So it's just part of the industry structure.
Pretty much.
Yeah.
And he argued RH's membership model is just a transparent way to handle that reality. It's not like high fashion where you can easily absorb markdowns.
And in this housing market,
He basically said not promoting would be financial suicide. Suggested competitors claiming they don't promote were probably just doing it in less obvious ways.
so the membership is about managing those necessary discounts openly.
That seems to be the strategy. Legitimize it, structure it, make it part of the value prop.
Looking ahead now, they teased a big new brand extension.
Yeah, the CEO sounded really excited about this, called it the biggest new thing we've ever done. Bigger even than their modern concept.
A $2 billion idea.
That's what he said. Highly disruptive, targeting the largest part of the market. They've apparently been working on it for 4 years.
And the launch plan?
Aiming for spring 2026 with 3 dedicated galleries. Greenwich, San Francisco, maybe West Hollywood. That West Hollywood one might even get a new courtyard restaurant.
Expanding the LA ecosystem.
Right. This sounds like a major strategic move to capture a whole new segment and fuel future growth beyond their current niche.
Okay, so let's tie this all together. We've gone through the numbers, the challenges, the big plans. What does it mean if you're looking at RH trying to see past that initial market dip?
Well, it really looks like RH is playing the long game here. You've got these near-term hits from tariffs, the revised guidance that's them reacting tactically to policy headwinds. It hurts profitability right now.
But underneath that,
Underneath, you still see that strong underlying demand. You see massive strategic investments in going global, in making their retail and experience, and now this potentially huge new brand concept. It's all about building long-term separation, becoming dominant in luxury home.
so a mix of short-term pain for potential long-term gain.
That sums it up pretty well. Immediate challenges versus ambitious future-proofing.
And what should people watch for going forward? What are the catalysts?
Definitely keep an eye on tariff policy updates. Any changes there could be huge. Holiday season demand will be telling. Progress on ramping up that U.S. manufacturing. And of course, how these new galleries, especially Paris, continue to perform. And eventually London and Milan.
So 2025 seems like it's about weathering the storm, navigating these policy pressures.
While laying the groundwork for potentially significant upside if those pressures ease and big bets start paying off.
All right. Now, as always, this next part is just us thinking out loud, purely speculative. This is absolutely not financial advice. We're just putting on our analyst hats for a minute. Okay. Consideration number 1, the real estate catalyst. RH has what, $500 million in estimated equity tied up in real estate?
Roughly, yeah.
Yeah.
Aspen, England, Detroit, Madrid.
Management says monetization is opportunistic. But what if an investor thought they should be less opportunistic and more, well, aggressive?
Like accelerate the unlocking of that value.
Exactly. If rates eventually ease and property values firm up, maybe execute those sale leasebacks or sales faster over the next, say, 12, 18 months.
And use the cash for...
Pay down debt, bolster the balance sheet, maybe even fund more international growth, but with less of RH's own capital, potentially easing that margin drag faster than expected. It's about forcing the issue, unlocking that dormant value sooner.
Interesting angle, pushing for faster value realization.
Okay, consideration number 2, the global partnership play. Karis is a smash hit, right?
Seems like it, yeah. Off to a flying start.
And the CEO mentioned optionality, getting inbound interest from places like Abu Dhabi, Dubai for partnerships, licensing. He even referenced the Bernard Arnault playbook for luxury brands.
Build iconic stores in key cities, Paris, London, New York.
Right. So could an investor bet on RH inking a major licensing or partnership deal, maybe Middle East or Asia in the next year or two?
That would be a capital light way to expand fast.
Totally. Get the brand into high wealth markets quickly, generate high margin royalties or franchise fees, accelerate that doubling the company goal without the massive capex of building everything themselves.
Betting that the brand heat from Paris translates into lucrative, lower risk global deals.
Exactly. It's about leveraging the brand power more rapidly. Again, pure speculation here. So recapping the overall picture, RH is definitely navigating some choppy waters right now. Tariffs, housing market weakness that led to that market caution, the revised guidance.
No doubt about it. But what really strikes me is how steady they seem on the long-term vision despite those bumps.
The global expansion, the U.S. manufacturing push, that big new brand.
It's a compelling story. Aggressive expansion, building unique experiences, aiming for real separation in the market. Immediate challenges, yes, but a very ambitious future plan.
So the narrative continues to be about building this premium, global, design-focused platform. It's definitely a company and a strategy that warrants watching closely both the numbers and the narrative.
And we encourage you to keep thinking about how these big strategic bets might unfold against, whatever the economy throws at them next. What does that mean for their path forward?
Absolutely. Remember, any strategic ideas discussed here are purely for educational purposes. They are not financial advice. Thanks for tuning in to The Deep Dive.